And hello, how you doing? Welcome to yet another week of Vishal and Company. It's just the three of us this time around. We're missing both Maddie and Joseph. Joseph has got a doctor's appointment today, apparently. I probably shouldn't have said that. You know, it's too much information. But he's not available to be here. And Maddie's off working, of course, as always. So it is just the three of us. And what we're going to be discussing today, man, earnings. Both happy and sad. So we're going to delve into that. Also, we'll be talking a little bit more about the oil and Bitcoin world. And wow, it's just going to be a whole tasty treat today in terms of economic analysis. We're going to start off with Vishal and the charts. So hit it, buddy.
Always a wild week, man. These past few months, maybe it's been a year. I've always been saying this. I hope I don't sound like a broken record, but it is just, every week it just amazes me. This week was probably the most, I would say, maybe blatantly frustrating week. I know a lot of my trader friends I was trading with, they were very frustrated, like literally pissed off at the markets because of the price action. A lot of F-bombs were dropped just because these guys would not let this market correct properly, or, a huge battle between the bears and the bulls here. And as you can see here on the S&P 500, the bulls are winning and they're coming back in a big way. The markets did open up red. They were taking out the lows of yesterday, but a strong recovery here across the board on the S&P, the NASDAQ, and the Dow Jones, and also even the Russell 2000. Personally, again, the S&P is the one that I'm a bit more bullish on just because we're above this technical level that I've been watching. However, on the NASDAQ and the Dow, we'll have to be careful here and wait and see. But it looks like so far the buyers are still in, and few things to talk about. I mean, the European markets were selling off as well. I want to sort of focus on the UK market, but I think before I do that, just two more charts here, market-related charts we should talk about. The first is that US 10-year yield. So take a look at that, folks. 1.93%. That's a pretty big move here in the yield, in the 10-year yield, and this is now basically forecasting higher interest rates in the future there. So I'm not sure how many rates that market thinks it is going to be, or the Fed's going to pull off. I'm thinking 4 or 5 still. But, next week we might be talking about 2% yields here. And generally when interest rates like this are rising, we tend to see the growth stocks or the technology stocks take a bit of a hit. So I'm a bit surprised that, the yield is so strong like this and the markets are still holding up here. So maybe it's the PPT or the plunge protection team, but keep an eye out on this. This is a huge breakout on the 10-year yield. And, a lot of it, I think, has to do with what happened over in England. But just before we get into that, one more chart very quickly, and that is the chart of oil. Believe it or not, folks, we are above $90 a barrel. So $100 maybe is even possible by the end of February. And,
do you think we're going to get the 150 that JP Morgan figures?
I'm thinking maybe by the end of the year, we might be like around 120. I'm not sure if we'll be 150, but I can see maybe 120. This is crazy. I mean, it's just going to add obviously to the inflationary pressures, not just fuel costs, but also everything else, because, you're paying, or companies pay for fuel, and generally they pass on those costs to the consumers. So this is obviously going to play a large part here in inflation. So keep an eye out here on the oil charts, because technically, if I go to my CFD chart, this zone, if I go out on the weekly, I do actually have a resistance zone here at around the 92 zone where we're exactly testing today. So I'm hoping to see a bit of a pullback. And I think the middle class is hoping to see a stronger pullback, and maybe the central banks as well. But, it's looking strong here right now. And I wouldn't be surprised if we're testing $100 by sometime even in February, if that's the case. So keep an eye out on oil. But let's talk about the biggie, and that is, we'll talk about the earnings, but I just want to focus here on the UKX, or the UK FTSE, which is the British stock markets. And the reason why I bring this up is because of this, of course. The Bank of England, first time hiking rates or raising rates back to back since 2004. Back in December, people need to realize the Bank of England, they were at 0.10%. and they hiked 15 basis points up to 0.25 in December. And then just yesterday, they hiked 0.25 or 25 basis points again, taking them to 0.50. But the most interesting thing was, I believe, four out of the nine committee members of the bank's monetary policy committee, think of them as the Fed presidents of the FOMC, I guess, but four of them actually wanted to raise rates 50 basis points to 0.75 rather than 0.50. But the five members got the vote, and they took rates up from only 25
That's an
basis
interesting split amongst policymakers, don't you think?
I
That's
think so,
true.
yeah. So, I mean, it sort of shows you that they're doing this as a way to maybe curb the large inflation. I believe in the UK, consumer prices rose 5.4%. And I know their energy costs are going crazy there, obviously, with the natural gas situation we've heard a few times there. And yeah, the Britain's energy regulator on Thursday announced a 54% increase in household gas and electricity prices. Uh, so, things
That's
are going.
intense.
Yeah, it's pretty intense. I think I was looking at someone's bill on Twitter. You can see people saying, "Hey, last year I was paying 120 pounds for the month for my electricity and gas, and now I'm paying 323 pounds. What the heck is going on?" So the inflation is there, and the big debate now going forward is, can central banks be able to hike enough to tame inflation? If you believe inflation is above 5% or higher, central banks will have to hike above that to actually tame it. But right now, the whole narrative is still that transitory inflation story where central banks are saying, hey, real inflation, like inflation should only be at 2%. So don't worry. Right now, it's due to supply chains and other issues. So we're going to have to find out to see around, mid of this year. That's sort of the time frame the Fed gave us, saying that by mid 2020, this transitory inflation should disappear and we'll be back around 2%. And then we won't have to hike rates as crazy as people think we have to tame inflation. But if that doesn't turn out to be the case, folks, the Fed's going to have to either hike or they're going to have to come up with some other excuse to
I don't
say,
think
hey,
this is going to come to an end anytime soon, especially because we're seeing the knock-on effects,
yeah,
which basically the rise in price of oil, that is
exactly,
also going to have a knock-on effect. It's going to be
yep,
like the vicious circle, basically,
100%. Yeah,
right? The big question is will they be able to tame it? Is that even possible anymore with with all the different external forces at play? Like,
yep.
do you think, TK, that the Fed still has the power to tame inflation, or has it grown well beyond their
Tools.
control?
I think at this point, it's beyond their control, not because they don't have the tools anymore. They could create the tools available for them to control it. It's their measurement, the actual value that they're trying to measure. So I'm talking about the 2% inflation that they
Yep.
try target for. If it's one of those things where statistics is usually a lie, which is a terrible thing to say, but if the institution that's telling you this is what the measurement we're trying to go for, it has a bias internal in it. So if you look at companies specifically who are affected by inflation before consumers are, so our inflation is kind of lagged behind manufacturing and production inflation. So companies have been experiencing 19% inflation on costs for inventories and stuff like that, and they slowly bake that into the price that they charge us for, which takes a lagged time compared to the 2% inflation or the 4 to 6, wherever it is at right now, inflation that the central banks kind of aim for. That in itself just puts them behind if they don't follow the actual purchasing power, the actual manufacturer or companies, I don't want to say, but
Hmm.
if companies are affected quicker than uh, we are inflation wise. But we measure our inflation according to consumer behavior, which is lagged. There's a time lag between realizing that inflation. If that continues to persist, it's just going to kind of bubble up and prices are going to continue going up. And companies have two choices here: either increase the price or try to reduce the costs. Ironically, we are part of the costs, employment wages and stuff like and stuff like that. So it's like either way, somebody's gonna lose. So there's no two ways to winning. I think it's now,
Yeah.
instead of the Fed having the tools left, it's kind of down to what the companies do to kind of catch that inflation train going.
Yeah.
So I can use Netflix, for example. They increased their prices recently, and their subscribers are down, or something caused the stock to plummet. But it was because their costs are higher for production of their content now than it was before.
Yes.
So to capture that, they had to either fire people, which the market doesn't like, or increase the prices on consumers, which the market didn't like too. So we're kind of caught between a rock and a hard place with the companies, and the Fed doesn't have a direct control over that kind of inflation. They focus on consumer price inflation, which has lagged a couple quarters. So I don't know if that answers it. Yeah, but
I would also argue though that the Fed has the issue with the debt, right? I think
because like Netflix itself is purely funded by debt. So if interest rates go up, it's screwed. I'm not just saying. I'm just saying these companies, all of them are pretty well leveraged on cheap money.
The thing is though, like Netflix and all these guys, they have junk bonds which are yielding. Like, I mean, I think Tesla bonds are like what, 10% or 11%?
Yeah, the last time I checked, it was like 8% for them.
Yeah, so they're already paying a high interest to borrow. These corporations are, but it's more the government and the consumer that are actually paying very less for cheap money, and that's the issue, right? It's more of like, and people are already talking about that. If rates rise, is that enough to now cause a recession in itself? Because consumers who are pretty much already in so much debt will maybe cut back on their spending. And then obviously government will have to either raise taxes, which might cause a slowdown further itself. So I think that's the big thing I'm watching. It's more the debt cycle. And believe it or not, I believe the U.S. Actually passed 30 trillion this week, if I remember. Yeah, we did. There we go. 30 trillion national debt the U.S. passed this week. So that's what I'm sort of watching. I know now this is now projected to be by 2025 somewhere around 55 trillion. So that's what I'm more worried about. If a rate hike, it's going to hurt the consumers and, well, mostly the government. A huge part, is going to be the government, because they're going to have to either raise money somehow through bonds or increase taxes, which in itself could cause a recession. So
yeah, but I don't think they can afford to look at it like Erdogan, who just said, "I don't like those statistics. You're fired." Yeah. So it's
36%.
Yeah, they can't live with their heads in the sand. They've tried it.
Yep.
They're doing it right now. But I mean, I think at some point they have to pull out. This can't be allowed to go further. I mean, this is ruinous if it gets.
Well, I mean, I'll let you know. There's already people who claim, right, that the Fed and governments are already hiding the real interest rate. There's a site called shadowstatistics.com that talks about this, who claims, the real inflation, and I think some of us have seen it as well, is probably somewhere in the double digits already here in Canada and the US. But obviously the way we calculate CPI, and we've changed the way too.
Well, see, that's the thing. Like they've completely. Something gets racy, they go, "Well, yeah, we don't want that in the core inflation rate. Dump that,
take it out." Yeah, that's why I'm like, if your measuring stick changes constantly and you're readjusting this, but the actual production is, you can see from companies that the actual production inflation is, or I won't call it inflation because people get ticky about that, but price increases or production costs have increased. It's just a reflection that if companies are experiencing 20 to 19% inflation, and these are usually the biggest consumers, or they buy the highest dollar value per product, you can kind of bake that in and say, okay, maybe what the 6 to 5% inflation we're getting from the Fed is not as realistic. And what makes it worse is people on Twitter now are kind of bashing that and spreading that kind of misinformation as well. And I'm just like, you know what? It's just a it's a self-perpetuating thing. If people feel like the inflation is there, people are
Yep.
going to go out and
Yep.
readjust their spending before the need was
Exactly.
actually there.
That's the
And
whole idea too. A lot of people say inflation is mainly psychological, right? Where, for example, say, prices are going to increase in a year from now, you might as well start buying things now. And then, hyperinflation is the more extreme case where if you know your money's going to be buying you less products tomorrow or in an hour, you spend that money right away, which basically increases the whole money velocity and creates, crazy prices. So
Now, Vishal, I've
yeah,
got a question for you.
sure.
And I want to make sure that I understood you correctly. Are you then of the opinion that, for instance, Netflix, which is heavily leveraged with debt money, do you think they're going to have a far easier go of surviving a rate hike than your consumer, or are they going to buckle as well?
So the thing is, it depends on how you, I guess define Netflix, right? Like, is it a growth stock or is it a value? I would still say it's a growth because they're not necessarily paying dividends. But see, the thing is, again, they have a large cash position. I wouldn't say they're, let's like, would you think people, if they had to cut money or cut costs, would they cut their costs from Netflix? Like, do you think it's now more of a, something like a cell phone where, it's not necessarily a discretionary product anymore. It's just something you need. I think that's sort of what you have to answer. I feel more, I think there's maybe more issues with, say, like a Tesla per se.
I think so.
But maybe
agree.
not a Netflix or say a Facebook where people are probably still going to use that products regardless. But that's just me. I mean, I don't know.
So if that's
I-
the case, then if you both believe that, if that's the case, then we're still left with the idea that the only place a person has to go is the stock markets, and will that not create a even more dangerous financial situation for both the economy and the people that are investing in the markets? TK, you take that one for right now.
So I actually wanted supporting what Vishal just said about Netflix and ironically Tesla as well. I don't want to go too much into it, but if you look at the numbers for Tesla, I think for every dollar of sales they bring in, it costs them $6 to make the actual end product. $8, sorry, I apologize. $8 to make the actual product. So if you bake in like a 5% inflation into that cost, their operating margin drops by like 20%. So their profits drop by 20%. That's just a 5% increase in their cost to produce whatever. Companies like Netflix make like 80% on every dollar they bring in. So they have more flexibility when it comes to maneuvering price inflation, just based off a simplified model like that. If you look at the actual production that's happening right now, not movie production, but like general economic production,
Yeah.
it's unsustainable
Yeah.
with interest rates that will with rising interest rates. But if interest rates are lowering and production continues at the same pace now, you kind of expect the market to readjust
Mhm.
a little bit to go to the mean. Now the mean could be 20% down, 50%. We're not too sure.
Exactly.
Was that's the big question now, is how much of this is actually real, real and tangible. But the numbers are kind of confused, and what Galen is always talking about is it is a lot of paper profit
Yep.
because there is not much else happening that companies, people, etc. are producing
Exactly.
are producing in non-productive assets, if that makes sense.
Yep.
And that's why I'm like, oh yeah, you know what? The real economy is probably 50% of what is actually
Oh,
happening.
yeah.
The rest of it might not be as real
Exactly.
as we would want it to be. The Fed's reaction to that now is either allowing people to come out and continue to pump the markets, or they just do what China did and pulls the plug and says, okay, you know what? This has gone pretty far. Inflation is at a point where we can't recover too quickly. We're gonna have to pull the plug on and consolidate our balance sheet I don't know who they're going to sell those bonds to, but
Well,
somebody is going to have to buy them.
Yeah, well, see, the thing is, they could technically be like Japan and Europe, where because they're in negative bonds, it's essentially just the central bank showing up at the auction. So it's the central bank
it's the central
buying
bank
the bonds.
buying the
You know, it's a whole Ponzi scheme, right? But
So
I mean, see, that's the thing, right? If the U.S. does that, like if we go negative and we start doing that, that raises the whole question about, you know, the reserve currency and the U.S. being, you know, the reserve currency power, if they can
So
do that. So
you figure that if they do that, they're going to bump themselves out of a reserve currency position. Is that correct?
it'll happen. I think it'll happen. I think, and I this is not something I'll say. Ray Dalio is kind of on the forefront of this, saying we are at the end of a
debt cycle,
the debt cycle, and not like our short-term 10-year cycle, but 100 to 150 years, where the U.S. to keep its dominant position has had to go over and beyond what it can actually do.
Right.
As Elon Musk said, a company, it's the funniest thing ever, but a company cannot be sustainable if it's spending more than it makes.
Oh, Jesus.
Yeah. So the man himself doesn't know how a company should work.
He just doesn't do it.
Just doesn't do it with his own company. But he's like, at a certain point, this is not going to be as sustainable as it is today.
Yeah.
And as interest rates at what they are today, it will be sustainable if this prolongs. That's the determining factor now, is how long can this prolong and how low can we actually go without disrupting a lot of the fundamental economy that's already set in stone. So I remember, I don't know whose story it was. I was back in school and they were teaching us about the mortgage rates and stuff like that.
I was about to say housing.
Yeah, the housing stuff.
That's the big one.
Especially here.
Yep.
I was looking at the cost for a 1-bedroom in Vancouver, BC.
Right.
Take a look at this.
Cost for what? I think it's 20%.
May fall 20% in some markets if we raise interest rates.
And a lot of that is, so just to throw some quick numbers at you, the board here figured out that the average home in BC is going for $700,000,
Mm-hmm.
the 1-bedroom apartment. And you can take a mortgage out 20% down for a full purchase price of $700,000 with $150,000 of your own cash.
Yep.
10% down, right, or something like that.
Yeah, you're paying close to $3,000 in mortgage expenses, depending on your bank or your broker, but on average $3,000. The rental prices right now are $2,200 with a 20% year-over-year increase. So that means that asset that you have before taxes and any other fees is generating negative cash.
Yep.
Just that one asset. And that tells you that real estate is not
skewed
cheap.
incorrectly.
It's not priced correctly. If you take the same approach and look at companies, you realize, a lot of these growth companies, if you actually look at the cash that they're bringing in and what the market is projecting, there's two different realities.
Exactly.
Happening. People, I think people understand the real estate market more because it's more tangible. You can actually see it. But I think you can do the same thing with companies and look at it and say, oh yeah, you know what? Something is just not making sense here. How can you be worth, it was $1 trillion, but $800 million, or whatever it is today.
No, that's true. Yep.
And generate $1 billion of cash before you pay for expenses. Something just doesn't make sense there. And that's kind of the adjustment I think will start to slowly happen. And we've seen cases, Peloton, Netflix, Facebook, Amazon is doing well, ironically, but
I believe they actually raised their Amazon Prime.
Yes, they did.
Prices as well.
They did. For in the U.S., they didn't do it.
They
didn't do it worldwide. Now, my question is to you guys: with the pitting of both Facebook and Peloton. I mean, Peloton's got its own problems besides that. But and sort of, is the tech ideal of the growth company, the Silicon Valley sale, the dream, is it showing the cracks that it should be showing? Like, are investors finally seeing it going, wow, this is a lot of fucking hype and value for something that's really not turning over the product? Is that happening? Or is it? So this is not a temporary thing. You envision that investors are now becoming a little more savvy to the social media sale, correct?
Yeah, I think it might. Oh, sorry, Vishal. I think two things. I'll throw it out there. Two
Yeah,
things might be happening here. One, I think Vishal is going to bring up. It might be asset allocation models.
yeah,
People might be rotating from growth to value just based off interest rate
yeah,
expectations and inflation expectations. The other one might be a realization that the fundamental value of the companies is not reflecting what it actually has been
yeah,
said to produce. So I noticed a lot of the earnings calls, CEOs have gone from optimistic guidance to either no guidance or a lowering of their guidance now. So it kind of tells you that, oh, yeah, you know what? We made $35 billion, but next year we're not too sure
yeah.
what it's going to be like. Especially for us, I'll give the Facebook example. The Apple thing came out. I don't know the full detail of the story, but basically, Apple was the gatekeeper to
Yes.
some of these guys, and they implemented stuff that might alter advertising,
Yes. The privacy
advertising,
rules.
right?
Yep.
And Facebook has adapted, but it's also being completely honest that the business model has changed. And that's the key now. Where you're like, oh, wait, so before we thought you had this humongous moat and you're telling us everything is good and you're going to spend lots of money to grow. Now you're telling us one little change like that can cause a problem in your whole business model, and investors pull back and you lose the net worth of, I don't know how many
I think
Fords they lost.
I think they
Yeah,
dropped 20. Was it
uh,
200 billion or some stupid thing like that?
yeah, yeah.
Yeah. In 2 days, one day, in overnight trading and stuff like that. And I'm like, yeah, people are either realizing that the asset models are changing, the asset allocation models are changing, or people are now slowly realizing that some of the quality of the earnings in the companies that they invested in are not as high as they anticipated before.
I think we should talk about that quickly too, or just mention that like some of these moves I've seen in tech stocks, folks. I've been like watching markets since 2012, and I haven't ever seen tech stocks move like this. Like the amount of post-market moves. I mean, like you have big companies trading like crypto altcoins. It's
Yeah.
really crazy, really volatile out there.
Now, my question two is, or not question two, I have another question. Everybody's applauding Amazon. Now, would its profits that it's reported over this last quarter have merely just been an effect of the pandemic? And realistically, as a company, if it didn't have people forced to stay in homes and buying their product, would it have produced the same results? Meaning that this is not going to be forever, that they too are probably suffering from the same thing. It hasn't hit them yet.
So you know what, man? Like I'm actually very surprised Amazon beat their earnings, because if you remember in December, we had like retail sales just cratered, and even online sales, right? Like that was the one that took the biggest.
Would their web services have kicked them over the top?
It looks like it's from a huge profit gain from Rivian stake.
Oh shit! Okay, well there's
there's
the headline which I should have just read. Yeah, no, okay, all right.
That's what you were alluding to.
And
it
also
is
disclose
paper
revenue
profit.
from its fast-growing advertising business.
It really is paper profit.
Yeah,
A lot of companies. And ironically, to adapt to this, the accounting rules have changed the requirement for companies. So before you couldn't recognize capital gains, unrealized capital gains in your income.
Mm-hmm.
Because it's not real,
Right.
but now you can. So these a lot of the income we're seeing right now is actually not
Really
tangible
income.
cash. That's so for example, Tesla's Bitcoin bet
Yep.
could actually generate them. If you don't dig deep into it, the number can actually continue to go up if Bitcoin continues to. Well, it's going down now, but if Bitcoin is actually continuing going up, Tesla can continue to make more cash than it's actually generating cash from its business, which is kind of ironic, but I guess accounting is not perfect. It's not a science.
Totally.
So they changed that recently, I think 2018.
So do you guys think this is a market thing, a NASDAQ thing, or is the tech bubble finally busted?
I think it's a long way to go. But I think a lot of the bubbles are in specific assets. So the Amazons, the Apples, etc. Some of those are definitely overvalued. But if you look at the distribution in the S&P 500, the top top contenders are usually the big names. At the bottom, they're companies that are generally not that heavily priced. It's just the way the index is kind of weighed. The big guys kind of influence more
Gotcha.
of what the actual value is of the general market.
So I
If
have a
you
picture here of the S&P 500 on my screen, and the
exactly,
size of the companies, it actually represents the size of like its market cap on the
Influence.
S&P 500.
Okay. Yeah.
So, your big boys are your Amazon, your Tesla, your Google, your Facebook, your Microsoft, your Apple, Berkshire there. So big
the
boys are
market
still there.
is weighed in one direction.
Yeah.
It's ironic that it's happened like this. It just means you are punished for your success because now everybody is watching these guys, and anything that happens, it generally moves the market. That's why I was very, and I'm to this day I am still surprised that Tesla is now in the
S&P.
S&P 500.
Now,
I
Mike.
am generally surprised.
Yeah, no kidding. Same here. Now, a question again. I seem to have a lot of them today. Is this conspiratorial, or is the market also being propped by people with interest in the actual performance of the market, like large institutional investors? Because we're so overvalued and outside of the realm of reality, would that not make it possible and easier for people like Kathy Wood to falsely prop up stock pricing and possibly even market indices?
I think
Uh,
so. I
yeah.
think so.
Yeah,
Yeah.
I would say so. So my take is two ways. Like, I think, if you look at a lot of the profits that the banks have been making, and remember, that's the company that, like, they're the corps that really get that cheap money. It's the banks, right? Because they're the ones getting that money from the Fed. And the whole idea with cheap interest rates was for these banks to actually lend more at a cheaper interest rate to get people to borrow, to spend in the economy. But people haven't really been doing that because the real economy is not the best. So what banks have been doing is taking that money and putting it in the stock market to make better returns and yield. And the retail crowd has followed too, right? Like, in my opinion, if inflation is going to be coming in higher, the best way to beat inflation is still to go into the stock market. If you want to beat that return. And the other thing, and we've talked about this plenty of times, but there is a plunge protection team, right? That the Fed has at the Federal Reserve Bank of New York. And their whole idea, the whole goal is to keep markets orderly. But a lot of people claim that they do purchase assets here. And, if you look at the volume sometimes, like on the S&P 500, there's a lot of big moves, but very little volume. And a lot of people are claiming that could be the PPT here trying to prop up. And if I was a central bank, this is my thing, right? Like, because of the environment they created where basically all money has to flow into stock markets for yield, it's mainly the pension funds, right? Because they have to make a return of 8% per year. And historically, before 2008, pension funds were mainly in bonds, government bonds. But, you can't really make 8% in government bonds now. So pension funds have been basically forced to be more risky when they're not supposed to take on that much risk because it's your pensions. And they've been putting money in the stock market. So my whole idea is, if there is a huge market crash, it could create this whole pension crisis. And in a sense, it is sort of in the best interest for the central bank to ensure that, markets go up for these pensions to keep going. But there is another way they can do it through the back door, and that is essentially because the central bank balance sheet is somewhat secretive. You don't really know what exactly they're holding. Technically, they can buy these stocks from these pension funds and put them on their book while the pension funds make that money just to stay afloat, which is something they could do to sort of keep them propped up in the future if that's the case. So I would say, yeah, man, I think there is some little fishy stuff going on behind the scenes. And I think Wall Street itself is going to keep riding this party until it's over, and they can just basically blame the Fed and the central banks for everything. And that's what, and let's be honest, that's what the retail crowd is doing too, right?
Yeah, no, absolutely. Now, Mike,
we keep saying by the dip, so
might as well just play the game.
Yeah.
Correct me if I'm wrong. it's still outside of the Fed's constitutional purview to even be considering the fucking stock market, correct?
Yep, exactly, man. Their dual mandate is stable prices and employment, maximum employment. But as people have said, the central bank has morphed into this huge, powerful institution that basically runs.
When did this
and
shift take place?
everything.
When did the shift take place? Was this in the 70s or the 80s? I'm having a feeling that things started to change really in the 80s in regards
ever
to
since
their control over the stock market itself.
basically ever since we went from the gold standard to Keynesianism, like it put more power into the central bank's lap. And if you look at the central bankers before then, they weren't like these rich rock stars, right?
Yeah.
No one really cared what the central bank did because they didn't really touch interest rates, nor did they care about, their only goal was to be the provider or the buyer of last resort if anything went wrong in a gold standard. But ever since we went off the gold standard, where basically interest rates were decided by the market, and if we didn't like what the government was doing, we could go and
demand they retract.
Take our gold back, right, and create a run in itself. Ever since Keynesianism happened,
there's nothing to
all
take
that
back.
power goes to basically the bankers. And I'm not saying they all were bad because Paul Volcker obviously is quite popular in terms of he was still sort of someone that had that gold standard education
mentality
and mentality. Yeah. Even the maestro himself, right? What's his name?
Bernanke.
No, Bernanke, the guy before him.
I'm not sure who that would be.
Oh man, what's his name? Hold on, I'll find his name. Maestro. What's his name, man? We all know who he is, man. Central banker. Sorry, but he's proposing. He's known for being this Alan Greenspan.
Mr. Greenspan. Yes,
Alan Greenspan, right? So he's known for basically saying that he moved the dollar and interest rates basically by following the gold markets, right? So he was sort of, in a sense, keeping the gold standard, but obviously doing it in his own way. And there's actually books where people claim Bernanke did the same thing, right, in terms of dictating how the currency moves. But Volcker, he was the guy who, when inflation, the last time we had inflation this high, he was the guy who said, "Yo, screw this, we're taking rates up to 20%, right?" And he was the guy who brought inflation down. And not many central bankers would probably be doing that.
That's true. That's true. It's kind of what Nassim Taleb was at before he went a little bit left. He used to talk about how a lot of the he was an option trader, I think.
Right.
So he said a lot of it was probabilities, what he was doing. And he used models that were also used by a lot of the central bankers for interest rates and stuff. And we're taught some of these models as well. And some of the assumptions that go into them is there is the most common is there's a 0.5% chance that outside the tails of extreme events will never happen. And his whole ethos was no, that chance of black swan events can actually be larger than you anticipate and expect. And your model does not have enough time to react to that, because this is human emotion kicking in, and you can't model that human emotions into your Excel sheet or whatever. And the central bank or banks in general still continue to use those models because it's the institutional imperative. If my guys next door are doing it, I'm gonna do it too. Why should I change the winning formula? there's no need to think.
Don't reinvent the wheel.
Exactly.
Yeah, so I'm like, you know what? At the same time, I feel pity for them, because if I was Fed Powell and interest rates are actually maneuvered by the market and they do dictate it to somewhat, if I can't control that and I just have to take liquidity out of the market just to save us from inflation, and then that causes the recession, I'll be like, what do you guys want? Did you want did you want the inflation, or did you want me to save the markets? Because I'm here just to do inflation and unemployment. And that's why I'm like, oh man, I hope he makes the right choice on. It's always the Sunday before the Monday is at a brunch. He has to make a big decision.
He's in a tough spot. I gotta be honest. Powell's in a very tough spot. He's like a lot of pressures on the guy, dude. It's going to be quite crazy. And I think his net worth is like 50 million, right? Because he was he's like the first non-academic. He worked like for a corporation, and
Before,
he's an
yeah.
accountant, I believe, right? Like he's not an economist, so
No.
the guy doesn't need the cash, man. I'm surprised he's taking on this pressure.
He just likes abuse.
Yes.
So okay, very fruitful discussion on all point or from all sides. I've got a quick one for us to end on. Where do you guys see Bitcoin heading in the next 6 months?
55
Zero.
million. Sorry, that's his name. 50 million.
Zero.
Same here. What do you think, Michelle?
I'm a bit cautious right now because apparently there's going to be some executive orders, like some government executive orders for crypto. So I'm worried about that because essentially I think it's in the best interest for governments. If they're going to do a central bank digital currency, they might add a bit more pressure on this type of private crypto. So I don't necessarily say it's going to zero right now. Just like technically, I'm watching this break here above 40K or 40,500. But I still think it'll still be around. But I'm just watching on the government side. I'm a bit more cautious now because I don't know how tough the government's or how strict the government's going to be here. We do know, I think India put a 30% crypto tax.
They certainly did.
Yeah, they just did, right? So a lot of people are claiming the U.S. might do the same thing, but then there's other people on the other side. A lot of Democrats are saying that, no, we're not going to do that because we don't want to look like China, right? Who basically went all out and banned it. So they're already bringing geopolitics to it. So I'm just sort of sitting on the sidelines here to sort of see what the U.S. does here. And I think, there's a huge rip on the cryptos today. So I'm assuming does someone know anything about what's going on, behind the scenes with the government, or is this just like a retest before we continue lower? So I'm still sitting on the sidelines, but yeah, that's all I have to say.
All right.
Yeah.
I'm gonna leave with my little opinion here. I think the bit of the bounce that we're experiencing right now are whales covering their ass, hoping that they're going to generate some FOMO and restart an upward trend.
Exactly. Yeah,
I think if the government actually gets into cryptocurrency, it won't be utilizing any existing currency. It will create its own digital currency
Exactly, yeah.
and basically outlaw or at least marginalize any other currencies that are in play. So I don't see any of these actually getting anywhere. I think the real thing is blockchain, but we still haven't figured out the use for it yet. So there you go. That's me, Chicken Little. The world's ending.
No.
Fucking buy silver and hide in a cave.
That makes a lot of sense.
I said I have a long here on XRP, man. So let's pump this up. Let's get this breakout, boys. Let's go.
There you go. Thanks, Elon. All right. Well, that's it for us this week. We've gone a little bit over, but I think it was a fruitful discussion, as I said before. Really thank you guys for listening in, those that did. And hopefully more people tune in later on. We'd love to see you and love to hear from you. So if you have any comments on the show or on what we've done or said, please don't be afraid to leave your comment. And we will respond accordingly. All right. Take care. We'll see you next week. Bye.